Why 500 a month will almost certainly make you a millionaire, and why most people are too stubborn to believe it. You make the single most important financial decision of your 20s and start dropping just 500 a month into the market. Come back 30 or 40 years later, and that one stubborn, boring, unglamorous habit has compounded into $1 million or more. I am completely convinced of this. And I think the people who refuse to believe it are the same ones who will spend their retirement years wondering where it all went. The prevailing myth that building $1 million nest egg demands a six-figure salary, some fancy credential, or a stomach for reckless speculation is, in my view, one of the most financially destructive lies that gets passed around. Consistent small habits, time, and the almost magical machinery of compound interest will get you there. Full stop. I want to break down the math, walk through the timeline, expose the traps, and talk about the mental framework that makes investing 500 a month an absolute game changer for your financial life. Here's why I believe 500 a month is both realistic and genuinely powerful. Strip it down and it is just $125 a week or $6,000 a year when you annualize it. If you are pulling in $60,000 or $70,000 annually, living modestly, not throwing your money at an outrageously expensive city, I am firmly of the opinion that $6,000 a year is achievable. It is not some fantasy number I invented to make myself feel better. But here is the thing I need to make emphatically clear. It is not the 500 figure itself that I worship. What I genuinely believe in, almost religiously at this point, is the act of investing consistently over a long stretch of time. Maybe you cannot start at 500. Maybe 200 is your entry point, and you claw your way to 400, and then 500 as life allows it. You get there by trimming the fat from your budget, by grinding for a promotion, by running a side hustle that throws off an extra 100 or 200 a month. Every dollar you can add to your monthly investing amount is compounding in your favor. And I believe the earlier you start stacking those dollars, the more ridiculous the outcome on the other end. Cannot overstate how much I think starting in your late teens or early 20s separates winners from everyone else in the long game of wealth building. If you are 19, 20, 21 years old and you begin investing intelligently, and by intelligently I mean simply and boringly buying an ETF or index fund that mirrors the market, you are lapping the field before most people have even laced up their shoes. When I say something like VTI or VOO, what I am really talking about is owning a slice of the entire US stock market or the S&P 500, which has historically delivered around 10% annually. Once you strip out the drag of inflation, that real return lands closer to 7 or 8%. Since inflation tends to hover somewhere between 2 and 3% in most years. That net figure is what I want you to tattoo into your brain when you are thinking about your future. Let me tell you why compound interest is the single most underappreciated concept in personal finance, and why I think every school in the world should be teaching it before algebra. The reason it is so profoundly powerful is that your original investment does not just sit there earning a flat return. It earns returns on its returns, and then returns on those returns, spiraling upward in a way that feels almost unfair once you see it play out. Take this scenario as an illustration. You begin with $0, contribute $500 every month, and earn 8% annually. The 10% historical average minus 2% for inflation. In year one, with no assumed growth, you are simply sitting at $6,000. By year two, you have put in another $6,000, but that original $6,000 has been growing, so your total portfolio lands at $12,480. Already you are outpacing your raw contributions. Scroll forward to year 5, and you would have put in $30,000 of your own money, yet the portfolio is sitting at roughly $35,000. And as you let the clock run, the chasm between what you actually contributed and what your portfolio is worth becomes staggering. At year 30, your contributions total $180,000, yet the portfolio is worth approximately $680,000. $500,000 conjured essentially from time and patience. What I find almost spiritually satisfying about this is the way that gap between contributions and portfolio value accelerates rather than staying flat. It widens and widens in a way that gets more dramatic with every passing year, because the money your money has made is now making money of its own. The mental image that works best for me, and that I think captures it perfectly, is a snowball rolling down a steep hill. It is small and manageable at the top, but by the time it reaches the bottom, it is enormous and unstoppable. That is your portfolio after a few decades of consistent investing. By year 40, the picture becomes almost absurd. You have personally contributed $240,000, yet the portfolio is worth $1.5 million. From a simple $500 per month commitment, held at 8% for 40 years, you have crossed the $1 million threshold with room to spare. In this illustration, we are assuming you started at 25 and let the clock run until 65, your standard 40-year working life. Now here is where I want to shake people by the shoulders. If instead of starting at 25 you wait until 35, you surrender an entire decade of compounding and land back at that $680,000 figure at retirement. The difference between those two decisions, one decade of delay, is the difference between $1.5 million and $680,000. I do not think people viscerally feel how catastrophic that gap is. By my rough math, that is somewhere between 800,000 and 900,000 of unrealized wealth gone simply because someone waited. Conversely, if you push the starting line back to age 20 and give yourself 45 years instead of 40, the portfolio swells to 2.3 million. Just 5 additional years of contributions at the beginning adds 800,000 to the final number. Genuinely believe this is the clearest possible argument for why I'll start investing when I'm more stable is one of the most expensive things you will ever say to yourself. Now that the math is on the table, let me tell you exactly how I think you should actually begin. My first piece of advice, which I consider non-negotiable, is this: if you work for a company that offers a 401k match, you must contribute enough to capture every cent of that match. In my view, leaving an employer match on the table is the financial equivalent of turning down a pay raise. To put a number on it, if you earn $50,000 a year and your company matches 50 cents for every dollar up to 6%, that means you contribute $3,000 and they drop another $1,500 into your account for free. I personally direct my 401k straight into the S&P 500, and if you can do something similar, that is exactly the kind of simple, high-conviction setup I believe in. After locking in the 401k match, I think the next move is opening a Roth IRA, and I want to tell you why I feel so strongly about it. I use M1 Finance for my own investments because of how streamlined and unfussy it is. The platform is secondary to the account type itself. A Roth IRA is, in my opinion, one of the genuinely great gifts buried in the US tax code. You can contribute up to $1,000 per year into it, a number I expect will continue climbing in future years. And then when you retire and begin drawing from it, you owe zero in taxes. Given that most people reasonably expect their income to grow over time, locking in tax-free withdrawals now, while you are presumably in a lower bracket, is a decision I think is almost always correct. One critical thing I want to hammer home here: depositing money into a Roth IRA is not the same as investing it. The money sitting in your account earns nothing until you actually deploy it into something. Buy VTI, buy VOO, put it to work. One more thing I would strongly encourage you to verify before committing to any investing platform is whether they allow fractional shares. This matters more than most people realize. I find it baffling that any platform in 2025 is still failing to offer it. When VOO is trading at $500 or $600 a share, the ability to put in 25 or 50 at a time and accumulate fractional ownership is the difference between investing consistently and sitting on the sidelines waiting to save up enough for one whole share. Even if your current best option is Robinhood, use it. As long as it offers fractional shares, you are in the game. You are in the game. You will go from owning 0.1 shares to 0.5, then to 0.8, and eventually a full share before you know it. Incremental accumulation is exactly how the habit is built and how the snowball gets started. My overarching recommendation on where to actually begin is simply this: start with whatever you can honestly afford and commit to increasing it over time. If $500 a month feels out of reach right now, $200 or $300 is not a failure. It is a starting point. When I first started investing during COVID in 2020, I was putting in somewhere around $100 to $200 a week. Now I am investing north of $30,000 per year. That trajectory is possible for a lot of people, and it happens by combining income growth with what I consider the most important financial discipline I know: resisting lifestyle inflation. If you get a $20,000 raise, I am begging you not to spend $20,000 more. Spend $1,000 or $2,000 more if you must. Let yourself celebrate a little, but funnel as much of that raise as you can back into your investment account. Keeping your expenses as flat as possible while your income rises is the exact mechanism that turns good earners into wealthy people. And the final piece of guidance I have, which I genuinely believe is the hardest part of this whole endeavor: leave the money alone. Do not look at it during a crash and make emotional decisions. Do not try to be clever and wait for the right time to get back in. Market volatility is not your enemy when you have a decades-long horizon. It is actually your ally. When prices drop, you are buying more units of the same assets for the same contribution. That is called dollar cost averaging, and I am convinced it is one of the most elegant and effective investment strategies available to ordinary people. I look at a chart of the S&P 500 and the 2008 crash. The event that upended millions of lives and felt apocalyptic in real time barely registers as a blip against the broader upward arc. Time swallows dips. Markets run more bull cycles than bear cycles. The S&P 500 has never posted a negative 20-year return. Never. I find that fact genuinely comforting, and I think you should too. Some of the pushback I hear most often: I don't make enough. My answer is always the same. Look for a side hustle. Audit your spending, find the category you can cut and redirect. Treat your monthly investment like a utility bill. Miss it and something serious has gone wrong. Another objection: the market terrifies me. I understand the feeling, but I have come to see it as irrational over long-time horizons. Historical dips are buying opportunities dressed up as catastrophes. Another one: starting too late. You are not. The best time was 10 years ago, and the second best time is right now, today, this week. The math is still extremely favorable even in your 30s. And finally, I don't know what to buy. My answer is as simple as it gets. Buy a broad index ETF like VTI or VOO. When you own VOO, you own a proportional stake in the 500 largest companies in America. Even if today's top 10 companies look nothing like the top 10 a decade from now, VOO will rebalance accordingly. It is passive, it is elegant, and over a long enough timeline, I believe it will make you wealthy. Here is what I want you to sit with when you close this piece. Imagine arriving at your mid-50s or early 60s with a portfolio that has been compounding quietly in the background for 30 or 40 years. The freedom that comes with that, real, genuine, tangible financial freedom, is one of the most meaningful things a person can build for themselves. Whether that means retiring early, stepping back from a job you have outgrown, generating passive income that supplements or replaces your salary, or having the capital to start a business you have always believed in, the options open up in ways that are hard to fully appreciate until you are there. The whole point is that money stops being a ceiling and starts becoming a launchpad. In summary, and I want to be direct about this, $500 a month invested consistently, started as early as possible, and left alone to compound, is one of the most reliable wealth-building strategies available to ordinary people. The earlier you start, the more explosive the final outcome. The more you contribute, the larger the snowball. Compounding and time are not just your friends. They are the most loyal, most dependable partners you will ever have in your financial life. You have a phone in your hand right now. Download an app. Open an account. Buy a simple ETF. Do it this week. Do it before you talk yourself out of it. It may feel boring in the short term. Decades from now, you will look back and recognize it as one of the smartest and most consequential things you ever did. And that is all I have for today. I've been Alex. I wish you well on your financial journey, and I'll see you on the next one. Peace.